Look at the top tier of American sports ownership right now. The entry price for an NFL or NBA franchise has soared past the $5 billion mark, while annualized growth rates are stabilizing. It is an exclusive, highly restrictive asset class where the biggest returns have already been realized. Then, on a single day in March 2026, over $3.4 billion of American capital flowed entirely outside that system. It bought 2 franchises in the Indian Premier League, a cricket competition played half a world away. The buyers were the apex predators of American sports ownership. The consortium that bought the Rajasthan Royals is backed by Rob Walton, the billionaire owner of the Denver Broncos, and Sheila Ford Hamp, who serves as the principal owner of the Detroit Lions. The second team, Royal Challengers Bangalore, was scooped up by a group including David Blitzer, a man who holds stakes across all 5 major U.S. sports leagues, and Blackstone, the world's largest alternative asset manager, making its first ever sports investment. These institutional titans aren't making a cultural bet on a new sport. They ran the math on audience scaling, media rights, and revenue intensity, and concluded that the IPL is a mathematically superior financial vehicle to the leagues they already own. To understand why Wall Street is suddenly buying in, we look back to the league's inception. When the IPL optioned its founding franchises in 2008, the entire league was purchased for $723 million combined. This chart shows the valuation trajectory of the Rajasthan Royals. The franchise was originally acquired for just $67 million. 18 years later, the Walton-backed consortium paid $1.63 billion for that exact same team, delivering a massive 24 times return on the initial investment. Add in the broader sports market, and the gap becomes obvious. IPL franchises are compounding at an annualized rate of roughly 24%. That dwarfs the 16% growth seen in the NBA and the 10% seen in the NFL. This aggressive growth is built on a very familiar structural foundation. The IPL operates as a closed system with no risk of relegation, strict salary caps, and centralized media revenue sharing. It is the exact same economic model that insulates American sports owners from risk. The league is also tightly capped at just 10 teams, with no regular pipeline for expansion. When global billionaires and private equity firms want a piece of the action, they are forced to compete for a strictly limited pool of assets. You have hypergrowth compounding on top of a risk-averse, familiar rule set, multiplied by extreme asset scarcity. For private equity, this creates a distinct valuation arbitrage, a rare chance to buy into a premium asset class that still has a massive ceiling. What makes this growth even more remarkable is the schedule. Traditional Western leagues run for 6 to 9 months. The IPL packs its entire schedule into a highly compressed 2-month window. In that short time frame, during the 2025 season, the league crossed 1 billion unique viewers across television and digital platforms. Fans accumulated 840 billion minutes of total watch time, with the final match alone drawing a peak concurrent digital audience of 55 million people. This graph compares the global broadcasting value generated per individual game. The IPL sits at roughly $16.8 million per match, pushing it past the English Premier League and making it the second most valuable sports property on Earth, trailing only the NFL. The specific rules of T20 cricket are uniquely suited to capture that value. The game is highly structured, naturally pausing after every 6-ball over, during strategic timeouts, and at the innings break. This creates far more high-value commercial slots than continuous play sports like soccer. The IPL functions as a hyper-condensed media revenue engine, generating its massive value across just 74 matches and maximizing the dollars captured per minute of live broadcast. None of those metrics happen in a vacuum. The gravitational pull of the IPL is directly tied to India's economic engine. India is currently the fastest-growing major economy, expanding at over 7% annually. With a median age of 28, a rapidly expanding middle class, and 750 million mobile internet users driving a massive consumption wave. The infrastructure delivering the sport is also consolidating. Following a massive 2024 merger between Disney's Indian operations and Reliance's Viacom18, all IPL media rights are now unified under a single platform, Jio Hotstar, which boasts roughly 300 million active subscribers. When American investors wire billions of dollars to buy a cricket team, they are effectively buying a proxy asset. It is one of the most direct ways to capitalize on India's inevitable rise to become the world's third largest economy. This map outlines how that capital isn't staying confined to the Indian subcontinent. Ownership groups are using their IPL franchises as a mothership, branching out to acquire parallel teams in South Africa, the UAE, and the UK. They are even establishing a physical footprint on American soil. Major League Cricket launched in the US with heavy financial backing from tech billionaires and features distinct IPL-branded franchises playing stateside. Of course, deploying billions into this ecosystem carries distinct risks. With franchises now trading at over 20 times their revenue, buyers are paying a massive premium based entirely on the assumption of aggressive, uninterrupted future growth. That rapid growth might hit a near-term ceiling. Because the recent JioStar Media merger effectively eliminated domestic broadcasting competition, analysts project the next round of media rights in 2028 could remain completely flat, without a bidding war to drive up the price. But the bet has already been placed. Live sports remain the last reliable way to capture mass human attention in real time. And as the cost of American leagues hits an impenetrable ceiling, the smartest money on Wall Street has decided the future of sports ownership relies on a cricket bat, a red leather ball, and 1 billion viewers in India.